And onto an article from wolfstreet.com. Don Quajones this time. He tends to cover the Spanish banking crisis pretty well. And we just got done talking about Banco Popular, sixth largest bank in Spain, purchased for $1 by the first largest bank, or the number one largest bank in Spain. Why? Because their balance sheet, the books were cooked so bad, they didn't know what the hell they were buying. So they're just trying to say, well, whatever customer base you have, we'll just take it. We'll get something out of this turd. And from what Bix Weir was saying, it's not surprising that particular bank bought Banco Popular because of the derivatives contracts that were swapped. They had a vested interest in scooping that bank up or something. So what are the chances that I'm about to do one of these? Another bank bites the dust. And you know what's beautiful about this one? Their title at Wolf Street is another Spanish bank about to bite the dust. Stockholders and junior bondholders fear a bail-in. What? On the last bank? No, another bank. Oh. After its most tumultuous week since the bailout days of 2012, Spain's banking system is gripped by a climate of fear, uncertainty, and distrust. Rather than allaying investor nerves, the shotgun bail-in and sale of Banco Popular to Santander on Tuesday has merely intensified them. For the first time since the global financial crisis, shareholders and subordinate bondholders of a failing Spanish bank were not bailed out by taxpayers. They took risks in order to make a buck, and they bore the consequences. That is how it should be, by the way. But banks, the bank investors, don't like not getting bailed out. Who wouldn't? Who wouldn't like to say, I'm going to make a gamble on this because they pay high interest rates, even though they're very risky. But that's why they pay high interest rates. So I want to make out like a bandit on the interest. But if by chance things go south, I'm not going to make out and I'm going to lose my investment or some of it or all of it. But then again, I got the government behind me. They'll just bail me out. So you know what? Let's go with this, right? Oh, who wouldn't like odds like that? I'm going to go to casino. I'm going to go to Las Vegas and gamble. And if I lose, I got a whale behind me to just keep giving me more money. Sure. Well, now they're worrying it could happen again. As Popular's final days showed, once confidence and trust in a bank vanishes, it's almost impossible to restore them. The fear has now spread to Spain's 8th largest lender. That was the 6th. This is the 8th. And it is called Liberbank, a mini bankia that was spawned in 2011 from the forced marriage or merger of 3 failed savings banks. This creature's shares were sold to the public in May 2013 in an IPO price of 40 cents. Or is it pence? Because we're talking 40 pence? 40 cents. By April 2014, so basically a year later, they were trading above $2. A massive 400% gain. But by April 2015, shares started sinking. By May 2017, they were trading around $1.20. But since the bail-in of Popular, Liberbank's shares have seriously crashed as panicked investors fled. Oh, we're not going to get bailed out. We're not going to get bailed out. Let's get out of here. Scenting fresh blood, short sellers were piling in. On Friday alone, shares plunged another 17%. At one point, they were down 38% before bouncing at the close of trading, much of it driven by the bank's own share buybacks. Again, what do these companies do? We'll do our share buybacks just to pretend that there's a bunch of liquidity coming in and everybody wants these things. No, you're swimming for dear life is what you're doing. Put your head above water as best you can. In the last 3 weeks, a whole year's worth of steadily rising gains on the stock market have been completely wiped out. The main causes of concern are the bank's high-risk profile and low coverage rate. By the close of the first quarter of 2017, Liberbank's default rate had reached 13%, over 3 percentage points higher than the national average of 9.8%, which I think sucks as it is, if you ask me, while its unproductive asset coverage rate was just 42.1% compared to 47% for Banco Sabadell, 48% for Bankia, and 50% for Saxa Bank, and 55% for Unicaja. Or is that caca, like poop? Because that's what these things are. Worst still, the vast bulk of the bank's unproductive assets are real estate investments. But how is that possible? All-time highs everywhere. What? After Popular, it is the Spanish entity with most exposure to toxic real estate assets, according to the financial daily El Confidencial. A remarkable feat, given the bank already had the lion's share of its impaired real estate assets transferred onto the bank balance sheets of Spain's bad bank, Sareb. It's not just the bank's shares that are feeling the pressure. With the memory of what happened to holders of Popular's junior, subordinate, and convertible debt still fresh in their mind, investors are divesting their exposure to Libor Bank's subordinate debt. On Friday alone, the bank's most recent issuance, dating back to March 2017, generated losses of nearly 10%, 9.8% to be exact. Libor Bank's management has responded the only way it can, with a slew of denials. The bank is nothing like Popular, it says. It is solidly solvent, and its deposits are safe, which is probably true. Even the deposits of Popular's customers are now safe, despite the fact that the bank had hemorrhaged $18 billion of deposits in the last few weeks of its truncated existence. It was this frantic run on deposits that ultimately sealed its fate, prompting the European Central Bank to conclude that the bank was failing or likely to fail, as I discussed a couple days ago. Banco Popular's demise is a stark reminder that Europe's banking woes are far from resolved, despite the trillions of euros thrown at them. The message the market is sending is that you have to buy solvent banks and stay away from those that pose high risks, said Rafael Alonso, an analyst at Bankinter, one of Spain's more solvent banks. I guess if there is such a thing. Another Spanish bank that could be considered to pose high risks is Unicaja, the product of another merger of failed cajas that is, or at least was, scheduled to launch its IPO sometime in June or July. As things currently stand, the timing could not be worse. And let me ask you, speaking of IPOs, I love these because I can compare them to the ICOs, the initial coin offerings. And we understand there's going to be some scams, because there's scams, and every time a new thing comes on, there's going to be scams. But would you rather put your money in a coin, crypto coin, currency, IPO, or would you rather put it in an IPO from a freaking insolvent banking industry using ancient techniques, ancient fractional reserve lending, debt-based system, or would you rather get out of that system and put it into these cryptocurrencies while they are going nuts? Did anybody see Ethereum at $338 when just 10 to 11 days ago it was 210? Show me an IPO on those kind of numbers. As things currently stand, the timing could not be worse. The greater the uncertainty over Libor Bank's future, the lower the projected valuation of Unicaja's IPO falls. Before Popular's forced bail-in and acquisition, the Unicaja was valued at around $2.3 billion. Now, just days later, it's valued at less than $1.9 billion. If the trend continues, the IPO will most certainly be shelved. Good day, sir. As for Libor Bank, if things don't improve soon and investor nerves aren't steadied, it too could find itself on the ECB's, European Central Bank's, Single Resolution Board's chopping board. Perhaps it too will be sold for $1. What could you get for $1? $1. To a much larger bank that, like Santander, is able to raise billions of euros of new funds at the top or at the drop of a hat, with other too big to fail banks like UBS and Citibank more than happy to lend a helping hand. And just like that, another smaller bank would bite the dust while the biggest banks get bigger and ever more dominating in the market. This, as I said before, is what Lindsey Williams' friend, the good one that had all the information, told him would happen. You are going to see all the banks bought up by the too big to fail banks. And when all the dust finally settles, after all this crap comes to a head, you're only going to have a choice to bank at the club members' banks. 6, 7, 8, 9, 10 of them. That's it. You're not going to have small ones. You're not going to have medium size. You're just going to have theirs. And I'm driving to work, and I see a new bank coming up. Chase. Wait a minute. Chase? You already have a Chase bank. Not even, I think, 2 blocks away. Maybe a block to 2 blocks away, max. There's already a bank over there. What is this doing? Why are you building one? They're going to be coming up like McDonald's. Why? Because they would know in advance. We're going to get all the banking action after the dust settles. That's our plan. We're the ones that run things, and that's what's going to happen. Competitive marketplace and, competition? Absolutely not. Well, this competition, there's 6 banks to choose from. Oh, kind of like the mainstream media. Owns all, everything's owned by 6 corporations. All media, period. Not just news. Is owned by 6 corporations. You do have a choice. You can turn the channel. Oh. But if I turn the channel, it's the same guy that owns it. Turn the channel again, and that's the same guy who owns it. Turn the channel for a 4th time, the second guy owns it. And then I find myself changing channels, and they're all owned by 6 of these people. Just like these banks. Yeah, you don't like us here? Go to Bank of America. You don't like Bank of America? Go to Citibank. You don't like them? Go to, one of our other club members' bank. Oh, how about Wells Fargo? Right. So, someone called me, a subscriber of mine. He was a guy that sent me some hydroponic gardening stuff. I did a little video on the stuff he sent me a while back. And he's like, and the only reason I'm telling you this is because it's not going to happen now. Or else I wouldn't share it with everybody to steal the idea. But he said, we need to get in on something to where someone needs to create a bank. And it's a cryptocurrency bank only. It doesn't do lending. It's just a place for you to store your wealth created from cryptos and or store the cryptos on their system as well, like your bank account. And I thought, that would be a good idea. And you could charge fees whenever they move money in and out, little tiny smidgen of fees, like really small fees. You could do that. That would be the way. Instead of doing loans and getting interest, nope, none of that. And I'm like, man, we got to reach out to Peter Schiff or somebody. Maybe he'd be the right guy. No sooner does that happen, the next day, someone sends me a link. I open it up. It's already being taken care of by some group. I forget the name of the company. They're already rushing forward. They're halfway through where they need to be. I don't know that what I just told you is how they're going to run it as far as no loans, only store cryptos. No, but it's a crypto bank. I'm like, oh, well, I guess someone already got that idea. So that's why I'm sharing it with you. But you're going to see that. And I hope this stuff competes directly with what these people have. And people realize, we don't like you guys. We don't want to bail you out. We'd rather use this thing. This thing's much better. And as I store my current cryptos there, they're getting more valuable. When I store mine with you, I get nothing, 0.01%. While you take my money and lend it out to somebody who shouldn't have the credit, they default on it, now we're all in trouble. What the? Right. So on that note, I'm out.